Today we're going to do a quick final look at workers' comp. I just want to show you a couple of videos so you can see what workers' comp fraud's all about. I won't show all of them to you because you have the links in the class notes if you want to watch them, and there's plenty more. There's several ways to look for these. You can look for workers' comp fraud under YouTube. You can just look at disability income fraud. Workers' comp is a lot of disability income, so and probably some of the most interesting ones simply because the opportunity for fraud is much greater because of the volumes. Is the Social Security disability income fraud. They're all out there. The ones I want to show you today are specifically workers' comp fraud cases, but a lot of fraud anytime, and that's why early in the semester we talked about morale hazard and moral hazard. So here we're specifically saying moral hazard, M-O-R-A-L, which is the illegal one, which is someone pretending to have an injury so that they can collect the insurance when they're really not injured. The morale hazard is, they take chances, they're not careful, they don't work hard to get back in shape to come back to work. They just don't have a strong incentive. It's not that they're doing anything illegal, but today I want to look at the moral hazard, the fraudulent side, the illegal side of those trying to defraud a workers' comp system. And then we'll really shift gears quite dramatically and talk about property and casualty insurance pricing. So this first one is a little hard to watch. This gentleman is claiming to be disabled. In order to claim to be disabled, his disability, he said, gave him, or at least his doctors or whoever, but the sense that he had an injury on the job, and it gave him the mentality of a young child.
You just tell us so this man can get it on film with your picture what your name is.
When Mark Cohen put in a disability claim on a slip and fall accident, he had a myriad of different maladies to choose from. What did he choose? That he had been left with the intellect of a 5-year-old child.
That was you lived in before?
But here, it was the town, it take long. It did take a little while to hear. That long time.
Apparently not realizing that this would have to be his public face for the rest of his life, Cohen sold his new persona to his insurance company during a videotaped interview.
Did they take care of you?
Yeah.
What do they do for you?
They teach me how to count and to read.
Then he went on with the rest of his life, his normal adult life. He even kept playing golf, which is where the cops arrested him for insurance fraud.
Just get out of the golf cart. Get out of the golf cart. You're under arrest for workers' compensation, fraud, and grand theft. Get out of the golf cart, please. Yeah, there you go.
And then he goes right back into the act. Very, very sad. I mean, just how stupid that you would do something that is that awkward, that difficult, and you're going to pretend that every time you're outside, and you have to always be looking over your shoulders. Pretty amazing.
What are they doing?
Once confronted, Cohen slipped right back into 5-year-old mode. Of course, he never explained why a 5-year-old was driving around in a golf cart and playing 18 holes. Most kids his age need a nap around the 5th hole. After successful hand surgery to correct a workplace injury, Steve Spencer was put on temporary total disability. Keyword being temp.
So temporary total disability. So temporary means he's going to recover, and total means he cannot do any work. And so, here's the hidden camera seeing this guy who cannot use his hand, and here he is shopping and carrying stuff easily in his hand.
Temporary. But Steve apparently decided that he liked not working for a living and devised a clever way to extend the length of his stay on the disabled list. Right before his visit to the doctor, Steve would strike his formerly injured hand over and over. The hits would irritate the hand, giving it the appearance of being inflamed. He would do this in his driveway and in traffic on the way to the doctor's office.
All right, so you get the sense of these frauds. This is a lot of work. These are people that absolutely must hate their jobs. Maybe they're just getting tired and they're just sick and tired of it. And so now they're going to spend some years in prison.
Workers' compensation can be a lifeline for people injured on the job. It can keep you afloat financially until if and when you're ready to work again. But billions of companies or dollars are actually being paid out in bogus claims, and some companies say enough is enough here. Tonight we will take you inside one company that is fighting back and seeing results. Does this guy look like he suffers with a bad back? Watch as he helps load this truck with heavy furniture. He makes several trips up the ramp, at one point lugging a refrigerator. Julio Recinos apparently wants you to think his back is so bad he can't work at all.
He's claiming just recently he cannot bend, stoop, squat, lift anything heavy.
And you're seeing all of that right there. Until a year ago, Julio worked at Guess Jeans in maintenance, but he claims a back injury left him with pain so severe and so constant he can barely stand.
Well, this far outweighs any work he was ever doing at Guess Jeans.
And this man who's currently under investigation also works for Guess. He claims to suffer with a bad right shoulder, the same shoulder you see him use to jack up his car.
Every claim I've been assigned to thus far by Guess, I have pictures like this.
Perhaps these two workers had no idea Guess would fight back when they applied for long-term disability. But with thousands at stake, Guess called in Ted Kerner, a private investigator who exposes people suspected of cheating the system.
We're sending a message. We're sending a strong message.
Kevin Saltier heads up the safety program for Guess Jeans. Fact is, they believe so strongly about their safety record and tough policy on fraud, they opened their new LA manufacturing plant to our television cameras for the very first time. Guess employs about 1,000 workers here. They say in 6 years they've reduced the workers' comp claims from 250 to 33.
In 1991 and 1992, we spent about $1.9 million on the workers' comp. We've reduced it down to $200,000. If you're going to exaggerate your injury or file a fraudulent workers' comp claim, we're going to get you.
All right, so you can see workers' comp is it's important to companies, especially these firms in manufacturing. You can see just what we're talking about is, hey, if there's things you can do to reduce your claims, you know, do them. So loss control, he's talking about the loss control, getting from a couple of $1 million in claims down to a few $100,000, from 250 something claims down to 33. But then you have the fraud side. So they decided to spend money against the fraud, and there's a cost benefit to that. If you spend $10,000 to try to discover fraud, or I don't know how much these detectives cost, $10,000, $15,000, $20,000, and they don't find anything, then you throw money away. But the companies are not going to just pay out this money without at least acknowledging the fraud and fighting the fraud. Now the Social Security system, they do have investigators as well, but the volumes are so enormous. It's really, really tough. In my life insurance class, we talked about the incredible volumes that Medicare has. Medicare is not workers' comp or disability, but Medicare has. It's too much volume to really do much other than just scratch the surface of fraud. But with workers' comp, it's a cost-benefit analysis. How much do we spend to try to save money? And there's probably also, even if on net, maybe they spend $50,000 and save $30,000. If they do it and it's public, then maybe that prevents other workers from even trying the fraud, and so maybe it reduces your costs even much more than you can possibly measure. But you know, this is one you might want to look. This is a pretty good video because it really gives you the company side of workers' comp. You saw how proud he was of how much better they got at their accident rates, how much they improved. And so, you know, this is a big deal for firms. Loss control. I don't know, I can't remember in this video if they talk about how the insurance industry in providing the workers' comp is part of this process, but I'm sure he works very, very closely with his workers' comp representative, and has probably even walked around the factory with that representative. And definitely you would look at historical losses, what's the most dangerous, what's going, you know, what causes the most loss, and what can we do to change that process. So interesting field, workers' comp. definitely needed. People get injured on the job. They definitely need some protection. And at the same time, you got to watch out the morale hazard. Anytime you do disability income, there's going to be high risk of fraud. And disability income, like workers' comp, is usually the highest incident of fraud of any type of insurance. So there are the two videos. If you want to watch them, we watched most of the first one. The second one is a little bit longer, and I think you'd find it somewhat interesting. If anyone's doing their paper on workers' comp, you can see YouTube is a really good source. There's been quite a bit of news coverage on these type of fraudulent claims. All right, so now we're going to radically change perspectives. We're going to move to the most mathematical part of the class, which is the pricing side. I'm going to do the theory first, and then we'll do the actual math problem that you'll see on the final. It's a pretty involved question, but if you get it all set up, it shouldn't be too difficult. So at a high level, an insurance price is essentially a discounted cash flow. Now, we talked about this when we talked about credit scores, the use of credit scores, this concept of a pure premium. Remember, the pure premium is the present value of the claims you're going to pay out, and just the claims, not loss adjusted expenses, not underwriting expenses, not the profit. Their pure premium, you remember they use that pure premium for to assess auto insurance related to credit scores. So the pure premium is the present value of what you pay out in claims, using some discount rate. We'll talk about the discount rate that we would use. On the life insurance side, they don't call it the pure premium, they call it the net premium, but it's a very similar type of concept. In my life insurance class, we actually price the net premium. In this class, we're going to price the full premium, including the expense and the profits. So a little bit different just based on the mathematics. So your premium today, the pure premium today, is the present value of future claims. We are going to use as a discount rate your expected investment return. In my career, there was several years there where I was part of the process of filing premiums with the states. Remember the states, remember when we talked about the mold crisis in Texas, how the state has these different tiers where as long as your premium is within the band, you don't have to get any further approval, but if you're outside the band, you have to get approval. Some states you have to get your rates approved every single year no matter where they are. And I was part of that process. And this is part of the question for those states that you had to get approval every single year. This was my responsibility, was to give them what the expected return on the investments was. So that's what we're going to actually use as our discount rate. It's a little more complex than that, and you'll see how we're going to bring in the cost of capital in this as well. But that's essentially what they're going to do. Remember, we're talking about float here. So you get the premium today, and you invest it today, and you pay out the claims in the future. And the difference between the premium today and what you pay out in the future, that gives you the opportunity, that time delay gives you the opportunity to invest, and that's the reason why we're going to use the expected investment returns in order to discount the pure premium. So when you pay claims in the future, there's usually, we think of two different types of businesses. There's obviously some in between, but property and casualty insurance can be short tail lines and long tail lines. So short tail lines would be like auto physical damage. If someone has a wreck in their car and they have an insurance claim, that's probably going to be resolved within 3 to 6 months. Very quickly. And then you have long tail lines. We talked about the long tail line of asbestos under general liability that, you could be talking 30, 40, 50 years, a very long time period, because a person's exposed maybe in the 70s to asbestos, but they don't get cancer until 2020, 2022, could be 50 years later. Now, you add to the net premium or the pure premium, you add to that the loading. What is loading? Well, loading is your expenses and your return on capital, your profit. Your expenses are both the loss adjustment expenses and the underwriting expenses. Loss adjustment are those expenses that you have directly related to paying claims. So the pure premium is the claims piece. You have expenses, LAE and underwriting expenses, and then you have return on capital. So remember Buffett had said, man, the insurance premium is really we're borrowing money. We're going to pay it back with claims and expenses. So float are those reserves. It's the liabilities that we have not paid yet, and until we pay it, we get to invest it and make investment earnings on it. So the insurance reserves are that. We're not going to use the insurance reserves specifically when we do the pure premium, but we will look at it when we look at Schedule P. When you see Schedule P, you'll see where the reserves come from. Now, what's really unique about insurance, and we talked about this on paper 1, is our cost of goods sold. We don't know that when we sell the product. It's a rare business, very unusual business. Most businesses, if you're a grocery store, if you're PepsiCo, if you're selling cars, most businesses, they know what the cost of goods sold is of the product that they're actually selling. There's no uncertainty there. It's not like Pepsi says, hey, let's sell a bottle of Pepsi for $1.50, but man, it might cost us 20 cents, it might cost us $4. We don't know, but we'll charge $1.50. No, they know their cost of goods sold pretty accurately, very accurately, before the product's actually sold, because they build the entire product and hand it over, and so they know that in advance. But insurance, you sell an auto insurance policy, you don't know how much it's going to cost you until the policy expiration date. So homeowners is a good example of that uncertainty. So auto physical damage is a very short tail line. Well, there's usually a very short period of time between the time the premium's collected when the claims are paid out, usually 6 months to a year, definitely less than 2 years. And that even includes the bodily injury. Now, there are some bodily injury claims on auto. So auto physical damage is the physical damage, but auto liability, that's when you pay out if you harmed another person. They've got to go to the hospital. Some of those can go on for many, many, many years, but the bulk of them are pretty short, very short term. So most of auto insurance gets paid out within 2 years. Homeowners is a very short tail line. If someone has a fire or wind blows their house down, it's pretty quick that it's going to be fixed. Now, obviously, we talked about the mold issue earlier with Dripping Springs and that family, the Ballard family, that their insurance company kept delaying paying it off, and it ended up harming the house and harming their health. But for the most part, homeowners insurance claims will be paid pretty quickly. However, if there's a catastrophe, and it's a large catastrophe, a catastrophe like a hurricane like we saw with Hurricane Harvey in Houston, the payout could take much longer, just because there's not enough construction people, there's not enough construction material. So the industry has to ramp up in order to handle the large demand for construction. So catastrophes can spread out over a few years, but for the most part, homeowners is a very short tail line. And as we said, asbestos, very long tail line. And on asbestos, they did not know their cost of goods sold for a very long time. Their estimates were their estimates, but very tough, because they knew, just like with the mold issue, that the advertising was getting ramped up, more TV commercials telling people, hey, if you have this cancer, call us. So that was creating a lot more interest and a lot more volume, a lot more frequency. And so, yeah, how much is your cost of goods sold going to be? You may not know for 20-30 years. All right, so that's the claim side. And then we also have the profit side. So let's talk about the profit side, because this one is a little unique when you talk about banks and insurance companies. So there's a required return on equity. We've already talked about that when we talked about the capital asset pricing model. Remember, the required return on equity, we say KE equals the risk-free rate plus beta times the market risk premium, or the equity risk premium. You saw that when you on the exam question for exam 1, that essay question. So this is the model we use. And when I was working with the actuaries, they needed a return on capital, a required return on capital. I used the capital asset pricing model. My firm did not have a beta because it wasn't publicly traded. So I went out and found all of our competitors that were publicly traded. There weren't a lot of them, but seven or eight of them, and I got their betas and then I adjusted that for USA's debt to equity, and got USA's beta, and that's how we filed it. The reason we use capital asset pricing model is because it's highly recognized. It's taught in colleges. It's very considered state of the art. So the regulators really could not do much to complain about that. We'll talk about this a little bit more when we talk about rate regulation and what some regulators in some states have said about return on capital. But essentially, we're going to use the capital asset pricing model, and you've seen that one. You should know that formula backwards and forwards. Even if you're an actuarial science major, you should know that formula. I was amazed working with actuaries. They call me to do the return on capital and do the investment income, and I go to the meetings to talk to them, and boy, they know these theories as well as I do. They're covered on the actuarial exams, and because of their math skills, they actually understand it at a very different level, because they somewhat understand the noise in a lot of the statistics. And so it was interesting conversations. I really enjoyed that part of my job. Now, insurance companies and banks, just like any other entity, have a required return on equity. What's different about financial firms is they also have what we call a required capital. That's how much net worth they must hold, and we talk about this net worth being a cushion just in case things go bad. So how much net worth? Non-financial firms, they talk about their optimal capital structures. That's where you hear of Miller-Modigliani. Hopefully you know this theory. You might want to go look it up again. If you haven't, you definitely don't want to interview for jobs if you don't know this theory. But for non-financial firms, they ask about how much do we fund our business with debt and how much do we fund with equity, and they ask the question, is there an optimal capital mix? And they have this photo right here. This is a good way to draw it. So hopefully I'm just reminding you of a theory you know extremely well, but if not, here's a real quick review. What Miller-Modigliani said, well, first of all, they said before taxes and bankruptcy costs, it doesn't matter whether you have debt or equity. If you use more debt, debt is cheaper than equity. Your cost of debt might be 4%, your cost of equity might be 8%, but as you use less equity and more debt, it's true debt is cheaper, but the more debt you have, it makes your cost of equity go up. And before taxes, before bankruptcy costs, the savings you get by using more debt is more than offset by the higher cost of the equity, and it has no impact on the firm. But what they said is, if you look at this after tax, as you add more debt, so let's look at this picture. They call this gearing, which is kind of a strange term. But essentially what they're saying is how much debt versus how much equity. Over here on the left, they're 100% equity. They don't have any debt at all. When you come to the right, they're 100% debt over here. And what the theory Miller-Modigliani say, this is the very famous chart for them, as you add more debt, your cost of equity goes up. You're a riskier company. Your cost of debt stays about the same until you borrow so much money that your cost of debt shoots up, and it probably should shoot up a lot faster than they're showing you here. But what happens to the cost of capital? They show that the cost of capital actually comes down. Why? It comes down only for one reason, and that's that's called the tax shield. Debt is tax deductible, equity is not. So as you use more debt in your financing, you're getting some of your cost of capital is covered by the U.S. taxpayer. So this is what we call the tax shield of debt. But at some point you use so much debt that your cost of capital starts rising again. And they don't really have it drawn. If you're actual science majors looking at this and say, how can this start going back up if the slope on this doesn't go up higher, especially if this line's flat? This line is just the weighted average of these two. So they should have had the cost of debt rise at the same time. The WACC rises. But anyway, so it's not the perfect chart here, but that's the theory. That's non-financial companies. That's the way they look at it. Cost of debt's less than cost of equity. So that somewhat implies you increase your debt. Your WACC should come down. However, not all else is equal. Because as you increase your debt, your beta rises, and so your KE rises. So before taxes, increasing your weight to debt has no impact on the value of the firm, has no impact on WACC. And the key here is the optimal level of the firm. If you want to maximize the value of the firm, you want to minimize their cost of capital. Because you know as your discount rate goes down, the value of the firm goes up. And what Miller-Modigliani said is the value of the firm is only the cash flows from the assets. It shouldn't matter who has ownership claims on those assets, whether it's debt or equity, because the value of the firm is the value of the assets, unless you can reduce your discount rate by using more debt, get the tax shield. Then those assets, the value of those assets go up because your discount rate is lower. So, so after tax, more debt, increasing your weight of debt, increases the tax shield, and so your WACC actually declines, increasing the value of the firm. Firm value is maximized where the WACC is minimized. Why? Because the cash flow for the assets doesn't change, but the discount rate's coming down. At some point, you use so much debt that your risk of bankruptcy rises, and what they should have drawn here is your cost of debt starts rising as well. And at some point, your cost of equity shoots through the roof. And at some point, if you become 100% debt, your cost of debt is going to be the same as your cost of equity, because if you're 100% debt, your debt holders are equity holders. There are no equity holders. So that's the traditional theory about capital structure. Insurance companies and banks are quite different. First of all, they have regulators that tell them how much net worth they need to have. So when we talk about capital for banks and insurance companies, we're usually only talking about net worth. For outside of financial firms, when you use the word capital, we're talking about both debt and equity. But financial services company, the word capital almost always just means net worth, just the equity of the firm. Do we have sufficient capital for our risk? And why is that? Well, most banks and insurance companies don't use a tremendous amount of debt. Just like we saw Warren Buffett said for Berkshire Hathaway, their debt is really their policyholders. Their policyholders paying their premiums in advance. So for the financial services industry, we tend to talk about capital just being the equity part. And regulators demand banks and insurance companies have a certain amount of net worth. For banks, it's called their Tier 1 capital, or their risk-weighted capital. You can look these up. If you're interviewing with a bank, you definitely want to search on Tier 1 capital and Wikipedia or somewhere, read what that means. Insurance companies have risk-based capital, and we'll address that a little later in the class so you can actually see that formula. But what these formulas are saying is how much net worth does the firm have relative to how much risk they're taking. And it might just not be regulators. It could be credit ratings. So if you have S&P or Moody's are rating your bank or rating your insurance company, you need to hold a certain amount of net worth so you can get the rating you desire. So if you want a AA rating, you'll have to have a whole lot more net worth relative to your risk than if you're okay with a BBB rating. AA is a very high rating, BBB is a mediocre or medium rating. So financial services firms, they use terms a little differently than other firms, especially the word capital. So here's the formula that we're going toward. A pure premium, that's going to be the present value of claims using our investment income rate as our discount rate. The present value of expenses, the same thing. We're going to use the investment return because we have some expenses we pay early in the policy, others we pay very late. So if we don't have to pay our expenses until the very end, we get to keep that premium and invest it until we pay those expenses. So the time value of expenses using the investment rate as our discount rate. And then I'll show you how we'll handle the profit. The profit's going to be the required return on capital compared to how much capital we need to have. So the required return on equity versus the required equity. That's going to be our profit. And I'll show you explicitly in the problem we're going to work how that gets set up. So yeah, our profit requirement is required rate on return on equity times the required capital. So the profit side of the equation, I want to show you how how this risk for insurance companies somewhat doubles up. So let's think about this. It's pretty amazing. It gets back to what we were saying about homeowners insurance. So I'll bring up homeowners insurance again so you can see why this is so critical. But on the profit side of the equation, the required return on equity, we're going to use cap M, but for insurance companies, beta can range from 0.9 to 1.2. But if an insurance company is very risky, they'll have a higher beta. So the required rate of return should go up with higher risk. Now I realize we talked about this on exam 1, that risk discussion we're talking about is systematic. So you can certainly say, well, with insurance companies, maybe higher risk, doing more homeowners insurance, that's riskier business. Maybe that doesn't affect beta because you can diversify that away. I'm somewhat going to ignore that here. But the riskier you are, the higher return you will need. The typical P&C company has a beta usually in the 0.9 to 1.2 range. Why is that? Well, the liability side of the P&C business tends to be uncorrelated with markets, and maybe even negatively correlated. Right? You have a really bad economy, like we saw with COVID-19 last year. Fewer people drive, and so the economy is doing badly, but P&C companies are doing great because people aren't driving as much. It's mostly unsystematic risk, but there is some systematic there, especially major hurricanes. The asset side, though, for insurance companies is very high beta because they're just buying stocks and bonds. That's their balance sheet. This isn't Amazon or Intel that have these massive property, plant, and equipment. Property casualty insurance companies, most of their assets are stocks and bonds, so that implies a high beta. Remember that the beta of the market is 1.0, so insurance companies, property casualty insurance companies are somewhat close to the risk of an average stock. They're not particularly low beta, not particularly high beta, but somewhere kind of in that close to 1 range. So the required return reflects systematic risk. What systematic risk, what economic risk really affect insurance? Well, inflation and commodity prices are the two that most affect on the liability side especially. If inflation goes up, it's going to cost you more to fix a car, get body parts, go to the store, to the auto mechanic. Inflation's going to raise all of that. If you have a hurricane, you're rebuilding houses, inflation's going to increase the cost of building houses. Same thing with commodity prices. If commodity prices are up, you're building houses with concrete and steel and bricks. If you're fixing cars and you got steel and aluminum, so commodity prices can be important. The rest of this, as we said, the economy side might actually be negatively correlated to the liabilities because people drive less. We did talk about the interest rates. I probably should somewhat highlight here on interest rates. We talked about the underwriting cycle. When interest rates are high, insurance companies tend to earn less because they can make more on the float. When interest rates are low, insurance companies tend to make more on their underwriting because they're not going to make as much on the investment side. So there probably is a link there. The rest of these currencies, government action, Fed actions, geopolitical risk, don't particularly hit P&C companies any more than any other companies. All right, so there's required. So the bottom line on required return on equity is it should be related to risk. So if a firm takes more risk, its required return on equity should be higher. Then we get to the required equity, how much net worth they should have, and that's also tied to risk. So here's what I'm talking about, the double counting that we have to put in here. If a firm takes more risk, their required return is going to go up and how much net worth they have to hold. So their return on equity, they're going to have to hold more equity, and then the return on the equity is going to have to be higher. So it can be tough. You almost be chasing your tail. As you take more risk, you're going to have to make a higher return. You're going to have to hold more net worth, and you're almost be impossible for you to catch up with yourself. Regulators require firms to have a certain amount of minimum net worth relative to their total risk. So regulators don't just look at systematic risk, they look at total risk. They use something called risk-based capital. Risk-based capital for P&C companies has 4 pieces. There's the asset risk side, which is mainly default risk for bonds, and then price risk for stocks. It's the risk that the bonds that they invest in will go out of business. We'll talk about P&C companies and the type of bonds that they buy. They tend to be fairly high quality bonds. And then P&C companies do buy a lot in stocks. They tend to have a pretty high stock allocation, unlike life insurance companies, and we'll talk about that a little later in the class. And so C1 risk is just the risk of default on bonds, and then the risk of a stock market sell-off for stocks. The C2 risk is the insurance risk. For P&C companies, that's mainly their catastrophe risk. So the best thing to use there would be to use the probable maximum loss, just like you did on exam 1. That's a little hard to implement in an industry-wide formula for risk-based capital, because every firm is so different, and you have to have essentially firm-specific models. So that's a little tough. If you ask companies to run their models and come up with their own C2 risk, you somewhat have the fox watching the hen house. That may not make sense. So C2 risk is really well developed on the life insurance side. It's still pretty weak on the property and casualty side, mainly because it's so hard to come up with what's the true catastrophe risk. C3 risk is interest rate risk. That's a huge issue for life insurers, but not such a big deal for property and casualty. Especially shorter tail lines, it's just not that big of a deal. So they do have float, they do better when interest rates are higher, but if you're doing auto insurance, homeowners insurance, your float's only a couple of years, so your interest rate risk is not that huge. And then C4 risk is just everything else, which is really, it's the main risk they cover there is the risk that another insurance company goes under, and you as a surviving insurance company have to bail them out. So that's about all they have. They call that business risk. So there's the risk-based capital. The regulators, again, are saying, hey, if you're riskier, you must hold more capital. So if you're selling a really risky insurance, you have to have more net worth. If you're buying risky assets, you have to have more net worth. And so the riskier you are, the higher your required return on capital and your higher your capital, especially if you take in C1 risk. If a company puts a lot of their money into the stock market, this required return on equity is going to go way up, because that's a very pure beta type of play, and your required equity is going to go up as well because of the risk-based capital. Rating agencies have very similar models, look almost identical, but just the components, maybe different formulas, but the components look very, very similar. And what they're telling you is, well, they won't tell you what the answer is, but they'll say, if you want to be rated higher, you must have more net worth relative to your risk-based capital. Now, what I discovered with these formulas, you would think that the capital model formulas of rating agencies would have a high correlation to their actual ratings, but they don't. And the reason for that is there's so much more going on in the rating process. But if you adjust for a few other things, like the size of the company in particular, if you stratify by size, you will find a pretty good relationship between how a firm does versus the capital models and their actual rating. Now, a lot of companies have their own internal models, so we definitely saw that at UTSA, had their own probable maximum loss model, their own standards, which were pretty strict because UTSA wanted to be a highly rated company. So this gets, I just want to bring this up because we've talked about this. Homeowners versus auto. Homeowners has very high ROE requirements and very high required net worth. So what does that mean? That means homeowner is an extremely expensive product to sell. I don't know if there are any insurance companies that sell homeowners whose return on capital is greater than the required return on capital. And that's why I talk about with State Farm and UTSA and Farmers, if they would just stop insuring people on the coast, they could probably return thousands of dollars to each one of their policyholders, because homeowners requires them to hold so much net worth, and they're not making much money off of that. Auto insurance has low ROE requirements. Remember, we talked about auto insurance maybe even being negatively correlated to the overall economy because people drive less when the economy is doing poorly. And also has low capital requirements. It's just not a dangerous business. It's a profitable business, not a dangerous business. So most firms like Allstate, State Farm, Farmers that do both auto and homeowners, they make money on the auto, they lose money on the homeowners, but they want to have both products because they want to kind of cross-sell these two things. But it is not a good business at all. Very, very tough to make money. All right. So we are going to try pricing a policy. The bottom line is, what is your return on capital? That's what we've got to do. If we're not making a return on capital, remember what Warren Buffett said. If the competition is forcing you to price so lowly that you cannot make your return on capital, get out of the business. Just stop writing that business. So for most businesses, they set their price up front for a target gross margin. Remember, for insurance, we don't know what that gross margin is going to be until the passage of time. So for insurance, the premium is a plug figure that produces the required, desired return on invested capital. Now, I say a plug figure for you actuaries. When you take your actuarial exams, it's actually a mathematically derived formula. I just can't give you that complicated of a formula. I worked with an actuary at UTSA where we actually did some of these pricing problems to train some of the entry-level finance majors. And I worked on this problem jointly with the actuary, and she made me change all the formulas. I'm going to show you how I do it, and I'll explain my approach to do it. She made me change it to the actuarial formulas. I used her formulas. I got the same answer I got that I got on my side using the Excel model. I got the same answer, but without the math being quite so messy. So I don't want you to learn some messy formula. However, if you are an actuarial science major and you're going to take the exams, you will have to learn a slightly different formula. Now, in my life insurance class, I actually use the actuarial formulas up to a point, but on the property casualty, I think it's too much. It's really just overbearing you with formulas that aren't necessary. So we're going to use Excel, and I'll show you how we'll do this in Excel. So our definition of capital is going to be our net worth. For a normal company, return on invested capital is their earnings before they pay interest over their debt plus their equity. For insurance companies, return on capital is their earnings after interest expense divided by their equity. We compare that to the weighted average cost of capital, the actual cost of capital, and we decide whether or not, if the price we're charging is going to give us a equal or higher return on capital than our cost of capital. So there is a function in Bloomberg. If you ever get on a Bloomberg machine, you type WACC, you type in your company and you type WACC, and it graphs return on invested capital versus weighted average cost of capital. I don't do that very often with insurance companies because I don't really trust Bloomberg on how they calculate return on invested capital or weighted average cost of capital, especially the weighted average cost of capital, because Bloomberg really only considers debt to have a cost. They don't look at the insurance reserves, and so I think their WACC is grossly misstated. But for other companies, it's really quite interesting. So if you've got a capstone class where you're looking at a firm and you're trying to assess how management is done, I'd strongly encourage you to go on Bloomberg and look at this WACC function. But what does it mean to have a return on capital greater than your cost of capital? You should have learned economic value added in maybe your 3013 class. It's really asking, is management adding value? The return on capital is greater than their cost of capital, they're adding value. It's the same thing as saying we only do positive net present value projects. It's the exact same concept. If a project has a net present value that's positive $20 million, then doing that project will increase the value of the firm by $20 million. All right, so for banks and insurance companies, we're looking at it from the shareholder standpoint. We're looking at return on equity, not return on invested capital. We're thinking about CAPM as giving us a required return, compensates the stockholders for taking risk. This will come up again. I'm going to talk about regulating regulating insurance prices. And for most of finance, the thought is that required return on capital should equal the expected return on capital. So if stockholders require a 10% return, then the firm should price its business to give a 10% return. If that wasn't the case, if your required return is 12%, but the company's only pricing their policies to make 4%, then the stock price is going to fall dramatically until that expected return gets up to 12%. Now, again, we're going to get into this later, so I don't want to preempt my regulatory article where we can see regulators actually prefer looking at historical returns, but finance is actually looking at today. What is the firm today? What is the risk-free rate today? What is the beta today? What is the market risk premium today? Historical returns are simply what actually happened, but we're not looking at what actually happened. We want to know what's expected to happen going into the future and what do our stockholders require. All right, so return on equity needed. Insurers and banks also need to determine the required equity. So you have a required return on capital and you have a required equity. Equity, that net worth, is the cushion you need for the risk you take, so it's directly tied to risk. More risky, you need a higher ROE. More risky, that means you need more net worth. So you need both a higher return and more net worth. So I'm sorry I'm being repetitive here, but just make the point, insurance is so different than other businesses you're used to. There's the risk-based capital we've already seen. We're actually not going to use, on the exam question, we're not going to use risk-based capital. We're going to use another simplified formula. You didn't pick a formula, you didn't pick a premium such that your expected return on equity is greater than your required return on equity. If you do that, you got a good business, all right? So that's where we're going. Before we do that, let me bring up the homeowners versus the auto again with actual numbers. Let's say homeowners business has a net income of $100 million, twice as high as the auto business. So from your accountant, you say, wow, the homeowners business is great, twice as good as the auto business. But then you look at the required net worth. Well, homeowners requires you to hold $5 billion in net worth. So you take $100 million divided by $5 billion, and your return on equities is only 2%. Your required return is probably 8, 9, 10%, but your actual return is only 2%. For the auto business, you're making $50 million, but your required net worth is only $500 million because it's not a very risky business. 50 divided by 500 gives you a 10% return. So, the auto business is actually the most profitable because we don't look at net income. We have to look at return on required capital. That's the key. And for insurers, 90% of that required net worth comes from the PML, and 90% of that comes from 10% or fewer of their customers. I forget at UTSA, it was something like 4% of their customers represented 96% of the required net worth. So they could have canceled business with 4% of their customers, and they would have been able to pay their remaining customers, they could have paid out 96% of their $20-something billion in net worth. I don't know what it is today, but back when I was there, they could have sent out thousands of dollars to their customers in dividends. So yeah, homeowners business is an unprofitable business, not just because of the low income it makes, but also because of the high required net worth. So if the required KE is 8%, 10% for homeowners and 6% for auto, so you can see if your homeowners is only making 2, but because it's risky, it requires a 10% return. Auto's making 10, but since it's not as risky, it only requires a 6% return. If you have 50% in each business, you have a return of 2.7%, but you need a return. You have a required return of 8%. There's no way you can make it. If all you did was auto, you would have a great business. You'd have a required return of 6% and you're making 10, and that's probably why Progressive and Geico have been auto-only insurers for so long. All right, so we've got it again. This is all repetitive. We're going to go through all this. This is much easier for me to show you this in Excel than just to read all these notes again. But our ultimate goal is we're going to figure out, we're going to do it in a slightly different way. We're going to talk about what price change does the insurance company need to meet their goal, versus just saying how much we will calculate the premium, but we're actually going to focus on the rate change, because that's what the state regulators are focusing on. So you'll see this when we actually get into the example. Remember that underwriting gain is premiums minus claims minus loss adjusted expenses minus expenses. We're going to use the term surplus. That's essentially the net worth of, whoops, there's a typo there, net worth of the company on a statutory basis, not on a GAAP basis. We'll talk about that. And remember I said we were going to use a different formula than the risk-based capital formula. We're going to use this formula to come up with our required return on required capital. We use a premium to surplus ratio. The industry standard is 3 to 1. What that means is you need to have at least $1 of net worth for every $3 of premium that you write, business that you write. So your risk comes from the premiums. When you write a business, when you collect premiums, you're accepting risk for those claims in the future. So what this formula says, for every $3 in premiums you have, you need to have at least $1 in net worth. Risk-based capital will be better, but I want to simplify it. We'll use the 3 for 1. The 3 to 1 ratio has been around for decades. I remember an actuary was telling me someone said this in a conference just decades and decades and decades ago. I mean, I'm talking early 20th century. And it just stuck. 3 to 1 just stuck. So we'll stick with that 3 to 1 with what we're doing. You would say something like Progressive is writing to a 3 to 1 premium to surplus ratio. That means for every $3 they have in premium, they need to have $1 in net worth. And we're not going to worry about using written versus earned premium. I might get into that a little bit when we talk about accounting. They're very, very similar. So hopefully we'll see that if we have time on the accounting side. All right, our return on equity is net income divided by net worth. We're going to use average net worth. All right, so let's go to the Excel. I'm going to stop on the notes right here. Let's go to the Excel, because right now my guess is some of y'all are like, wow, that's not following him. This is really hard to capture. I've given you all the pieces, but what we need to do now is actually apply it. We need to actually do the math. And when you do the math, I think you'll understand how all these things fit together. This is the problem. We're going to walk through. And it's going to look very similar. I actually, tonight I'll get this one started. We'll probably work this whole thing through. It may be a little fast. Then the beginning of the next class, I'll work it again more slowly, and then we'll do a practice problem where you can practice. I'll use the exam question from last year so you can see exactly how it works. So let's try this. So CY is the current year. NY is next year. And obviously PV is present value, so just so you know. So this year we're charging a premium of $400. Our claims are $285. Our loss adjustment expenses are $35. Our expenses are $70. Underwriting gain is 10, whether that's 10,000, 10 million, whatever. Our required capital, remember our required capital is we're using a 3 to 1 premium to surplus ratio. So how much is our required capital? Well, our premium is $400, so you take 400 divided by 3, and that tells you what your required net worth. So that right this $400 in premium, we need to have 133.33 in net worth. Okay? Now, what we need to do is forecast next year. I don't know if this 400 is the right number. What we're going to do is figure out what the right number is here. So let's start with claims. Our claims are going to grow by 3% in frequency, and they're going to grow by 3.5% by severity. So what we're going to do is we're going to take this year's claims times 1 plus the growth in frequency, close parentheses, times 1 plus the growth in severity. I'll put this formula off to the side so you can see it. So we expect our claims next year to be 303.82. Why? Because frequency goes up 3%. Why does frequency go up 3%? Well, maybe COVID was so impactful that fewer people were driving this year, but next year we expect them to drive more. Maybe speed limits have increased. Whatever. We just expect more accidents. Severity goes up 3.5%. That could just be inflation. Just car prices, car parts have gone up with inflation. It could be maybe the speed limit's been increased, and so the actual accidents are going to be greater. It could be that distracted drivers is increasing both the frequency and severity. We're noticing more and more people using cell phones. These could be negative growth. If they change the law in a city, making it illegal to drive with a cell phone, that might actually bring down the claims. For whatever the numbers are, we expect next year's claims to be 303.82. Same thing with LAE. We expect the frequency to go up 3% and severity to go up 2%. So we do the exact same thing. We take this year's LAE and we multiply by 1 plus the growth in frequency times 1 plus the growth in severity. So you see where we're going here? That gives us 3677, and our expenses is even easier. Our expenses grow 2.5%. There's no frequency and severity for expenses, so you just take expenses times 1 plus the inflation on expenses. So what is my underwriting gain? My underwriting gain is going to be, and I'll give you these formulas off to the side. You probably won't be able to finish this problem today, so we're getting close on time here. What's my underwriting gain? It's going to be my premium. We still don't know our premium. I just plugged in a number. We're going to calculate that. Minus my claims, minus my LAE, minus my expenses. So there's my underwriting gain. Very straightforward. We've already seen that before. All right. So let me do one last thing here, and then we'll leave it and we'll finish it up next time. So we're going to pay out 303.82 in claims, but we're not going to pay it all out today. So we want to look and see what is 303.82 but in today's dollars. Well, we look here and we notice that the timing on all of these things, on frequency, on claims, LAE, and expenses, the timing is 1/2 of a year. That means on average, we pay these out in 6 months. We may pay some out today. Someone buys their insurance, they have an accident immediately. Some buy their insurance, they have an accident in 6 months. Some buy their insurance and they don't have an accident until a year from now. But on average, it's 0.5. So all we're going to do is we're going to take those claims, we're going to divide it by 1 plus our investment return, 4%, raised to the time. So in present value terms, this 303.82 is really 297.92. We'll do the same thing with LAE. We'll take our LAE and divide it by 1 plus our investment return raised to the time. Now the time could be different for each one of these. I might use 0.5 there, and I'll probably use the same time on these two. But my expenses might be 0.75 or something. In this case, I made them all the same. So there we take our expenses, the exact same formula. 1 plus the investment return raised to the time. And there's the present value. So if I sum up these present values, I get 404.34. If I sum up the undiscounted, I get 412.35. So let me put these formulas off to the side so you can see them. And you'll notice they're all exactly the same. Just all the way down. What you divide by is exactly the same. In this case, because I made the timing the same. So we're using the same discount rate for all of them. The B23, which is your investment return. We're using the timing. I said the timing was same for all of them. So here's the sum of the claims, LAE, and expenses. The sum of those undiscounted. Without discount is 412.35. The sum of these, the present value, or the sum of the present values of these, is this number right here. So how much is my investment income, my float? My investment income on my float is just going to be the difference between the undiscounted number and the discounted number. We're going to make $8.01 on that. There's one other adjustment I want to do on investment income, and we'll put that in. So I'm going to leave it here. So the key here is probably practice what I just did. You have to do two things. You have to forecast the claims using frequency and severity. You then have to get the present value of the claims by taking the forecast claims, dividing by 1 plus the investment rates at the time, and then you'll compare those, the sum of those two, and that difference is your investment income. All right, so we'll leave it there, and next class we'll finish up this problem.